Hello, and you're watching the week ahead of London Capital Group, taking a look at the week beginning Monday the 9th of November. But before we discuss the week ahead, LCG head analyst Brenda Kelly shares her opinion on today's non-farm payrolls report after jobs growth in the US surged in October to 271,000, far beating market expectations of around 180,000.
I think it was a very good number and certainly well ahead of analysts' expectations, but it's not the non-farm payroll number that is the most important. It's more about the wage growth, and that did beat expectations by a large margin, 0.4% increase on the month, and on the year 2.5% increase. So it's been a long time coming, but it must be borne in mind that we have been here before and we have seen these mild pops in wage growth and then not had a trend along with it. So really, at the moment, the market has put the probability of a hike in December at 76% or thereabouts, and that's well up from the 58% it was just before the release. What has to be noted though is that in September everything seemed to be on an even keel in terms of the US macro data, but the Fed actually referred to external pressures, namely China, as the reason for the lack of action. So next week will be very important. Data dependency is not just domestic, it is a global phenomenon, and what happens in China next week will ultimately be a deciding factor for the Fed.
Moving on to next week, the markets will be focused on China come Tuesday and Wednesday, with the release of Chinese industrial production, inflation, retail sales and fixed asset investment for October. Brenda discusses what the market will be looking out for.
Well, certainly over the last number of months, we have seen some very poor China data. So we would like to see a little bit of a bounce in that. So, for example, the CPI inflation data, not going to be all that great. Probably going to see a 1.4% print on that. The median expectation is 1.5. Of course, this is lower gasoline prices and, of course, food prices also taking their toll too. So that, in some respects, is will be closely watched. And, of course, the exporting of deflation to Western world is something that is very important. So if we feel that deflation is going to take hold, or certainly a lack of inflation is going to remain, then that could very well put paid to any Federal Reserve decision. Certainly it won't be the main factor, but it will be a consideration for them. When it comes to industrial production, again, we've seen some dire numbers over the last number of months. We're expecting to see a pickup there, around 6% in October, probably by improved demand from infrastructure investments, and then fixed asset investments, again, a little bit of recovery there, probably easing about 10.2% year to date. So that would have picked up last month from 6.8% to 9.3%. So I think the Chinese numbers are going to be better than before, but again, we're coming off quite a low base, and retail sales, in my view, will be the most important factor for China, given the changeover in the way they want their economy to run. They want to see domestic consumption increase, and we're expecting to see retail sales there climb by 10.9% year on year in October. So that will be a decent number, but any failure to meet these could very well put the Fed back out of the driving seat and see us look into next year for any hike.
Come Wednesday afternoon, and the sterling will be in focus with the UK's latest employment figures.
Well, oddly enough, you could say that the unemployment rate here in the UK is actually fairly decent. It's back down pretty much near to pre-crisis levels. And again, wage growth will be an important factor here. Given that Mark Carney didn't go ahead with a rate hike, or even another person actually voting for a rate hike at the QIR yesterday, it does imply that we could be waiting another 4 to 6 months for the Bank of England to actually act. So this will be very closely watched. If we want to see wage growth above the 2% mark, and again we want to see an underlying trend gain some momentum if we're going to see a move higher, and I suppose any speculation that there'll be a hike. But I do feel overall the pound is going to continue to be under pressure in light of the surge we've seen in the US dollar. For example, the dollar index is now up at 99. We haven't seen that level since mid-April, and it's pushed the pound down to a 50 handle. So if that $1.50 level actually breaks, we could very well see the 148 level in pretty jig time. And at the moment, the propensity is for that to happen. Over the last 48 hours, the pound has lost 4 handles against the US dollar. So everything is a barrier for the pound at the moment, and it will take quite a big number for that to change.
Also on the agenda, EU industrial production data is scheduled for release on Thursday morning at 10 a.m. GMT. Another interesting data release for the markets.
Well, industrial production, if you exclude construction, has fallen by 0.5% back in on a monthly basis back in August, and this was all down to the big four, the likes of Spain, Germany, Italy, and France, all showing very weak growth there. So, and also the manufacturing component of the PMI fell slightly in September. It is still in expansionary territory, but not looking for much there at the moment. A 0.1% increase on the month, and I would imagine that anything higher than that will be very hard to come by. Certainly at the moment there is a certain amount of optimism around the Eurozone, but there are still many looking for some action from the ECB, whether that be another cut to the deposit rate or additional quantitative easing. I would temper that in light of what's happened today with the US dollar. There seems to be little reason for the ECB to make any real inroads in the very near term, but they may very well, I suppose, if these numbers are poor, look to jawbone the market down. But again, on the euro-dollar pair on that particular point, the fact that we've dropped through the 108 level is a big, massive level. A lot of options expire at that particular point, and at this moment in time, that should become a resistance point. So while below the 108 level against the US dollar, there is a big chance for us to head back to 106.30, and then the 105 level does seem for the majority of the brokers to be a very credible year-end target.
The euro will be in focus again Friday morning with the release of third quarter GDP figures out of France, Germany and the Eurozone. Brenda discusses GDP growth expectations.
Well, France has been okay. Germany has had a little bit of weakness over the last number of days, particularly. We've seen factory orders slumping, industrial numbers also on the back foot as well. So it seems like there's been a move from the core to the peripheral in terms of growth. Certainly in terms of France, I think the Q3 GDP growth forecast is about 0.4%. I would see downside risks to that. Again, this recovery in France has been slow to take hold, so we could very well see about 0.3% on the month. In terms of Germany, we could probably expect to see a 0.4% Q on Q there as well, and the year-on-year rate probably improved to about 1.8%. But we do have to bear in mind the corporate aspect and the fact that we have a Volkswagen scandal taking hold, and that's probably spreading to a large part of the car makers in Germany. So that could very well start to take hold, not particularly at this point, but certainly in the forward-looking numbers for Q4. So I would be very wary of that. But all it will do is, I suppose, put the onus on the ECB to provide additional stimulus. And at the moment, given the trajectory of the euro, it could very well be a flash in the pan.
And finally, wrapping up the week, US retail sales and PPI data will be released in the afternoon. Given today's upbeat US jobs report, the market may be hopeful for a positive read.
Well, the US is a very consumer-led economy, and you would like to see retail sales remain on the up, particularly now in October and in the final quarter of the year. We're estimating that total retail sales rose about 0.4% month on month, and maybe ex-auto probably rose the same 0.4% as well. So it's not going to be a stellar number, but certainly it'll be better than some that we've seen over the last number of months. So over the last time we saw a 0.1% increase on the month. Very poor considering, but I would imagine going into the holiday season we might see an improvement there. And of course, with the jobs number that we've seen, it could very well surprise to the upside, which will only ramp up speculation that the Federal Reserve will hike.
That's all for today's Week Ahead. Join us again next week, but for now, have a great weekend and goodbye.